So you've seen it all over social media, right? The fancy cars, the screenshots of huge profits, this dream of making a killing in the markets. But here's the thing. There's a really harsh reality that nobody likes to talk about, and it's that most people who try this, they fail. But why? What's the real difference between the people who just gamble and the ones who succeed? Well, it all comes down to understanding the basic language of risk, and that's what we're going to break down right now.
You see this number pop up all over the place, and honestly, it's a bit scary. 90%. That's the figure you'll hear from multiple sources for how many new traders lose money and end up quitting. Now, that is a wild failure rate, but it's not because the market is some big conspiracy. Nope. It's because most people jump into the deep end without ever learning how to swim, without understanding the fundamental rules of the game.
So what's really happening to that 90%? You know, it's not really about having a bad day or hitting a string of bad luck. It's about discipline. This quote from Stick Trader just nails it. A single loss isn't what blows up your account. What really destroys you is when you throw your rules out the window because you're scared, or maybe you get a little too greedy. And that whole breakdown, it almost always starts because you don't truly understand the tools you're using.
All right, so let's frame this the right way. We're here to tackle that 90% problem head on. And the first step to making sure you don't become part of that statistic is to master the language of risk. And that means we need to get a handle on 3 core concepts that every single professional trader lives and breathes by. Okay, so where do we even begin? Well, we start with the most basic unit of measurement. I mean, think about it. You wouldn't try to build a house if you didn't know what an inch or a centimeter was, would you? Of course not. In the world of trading, our inch is something called a pip. It's the absolute foundation for how we manage risk. So, what the heck is a pip? It's actually super simple. A pip is just the smallest possible price change that a currency pair can make. Think of it like a single tick on a clock, or 1 degree of temperature on a thermometer. It's just a tiny, standard unit that lets us measure how far the market moved. So if you hear a trader say they made 50 pips, they're not talking about money yet. They're just talking about the distance the price traveled. Okay, so pips measure the distance. Got it. But a 50-pip move could be worth $10, or it could be worth $1,000. So how do we figure out the actual money value of that move? Well, that brings us to our next crucial building block, the lot. A lot is just a standardized quantity of currency. It's the size of your position. And this is so important because the size of your lot is what directly controls how much money each one of those pips is actually worth. A 10-pip move can mean totally different things to your account balance, and it all depends on your lot size. Now, lots come in a few standard sizes. A standard lot is a big one, 100,000 units of whatever currency you're trading. A mini is 10,000 units, and a micro is 1,000. And here's the key takeaway, the thing you have to remember. The bigger your lot size, the more money you make, or lose, for every single pip the price moves. This is where real risk management actually begins. And now, for the big one. The concept that can feel like a superpower, but can also be incredibly dangerous. Leverage. You're probably wondering, wait a minute, how can I trade a 100,000 unit lot if I only have a couple $1,000 in my account? The answer, my friend, is leverage. Think of leverage as a loan from your broker. It's what allows you to control a huge position in the market with just a small fraction of your own money. It basically amplifies your exposure. But the key word here is amplifies, because it amplifies everything. Your potential wins, and, way more importantly, your potential losses. It is the definition of a double-edged sword. I mean, just pause and think about this for a second. With only $1,000 of your own money, a 100-to-1 leverage ratio gives you $100,000 in trading power. That's enough to trade a full standard lot. It feels amazing, right? But the danger is just as big. A tiny price move in the wrong direction can completely wipe out your entire $1,000 deposit before you can even blink. And would you look at that? Here we are, full circle. That 90% number is back. According to insights from the Trading Channel, it's that same 90% of beginners who make devastating mistakes with leverage. Why? Because they see it as free money or a shortcut to getting rich, not as the high-stakes financial tool that it actually is. So, we've got the tools down. Pips measure distance, lots determine value, and leverage amplifies the outcome. Now, let's put it all together. This is the moment where we make the jump from trading based on hope, like most of that 90%, to trading with a real statistical edge, like a professional. So, how do the pros use these tools any differently? Well, there's a great analogy from the spiritual trader that just captures this perfectly. Let's imagine 2 traders, Tom and Sarah. Tom kind of thinks his strategy works. He guesses his win rate, he hopes his wins are bigger than his losses. He's really just trading on a feeling. But Sarah is all about the data. She's tracked hundreds of her trades, she knows her numbers inside and out. And this is what her data looks like. Sarah knows for a fact that she wins 58% of her trades. She knows her average win is a solid 42 pips, and, just as important, her average loss is only 20 pips. This creates what's called a positive expectancy. She has mathematical proof that as long as she sticks to her plan, she will make money over time. That, right there, is a real trading edge. And here is the entire point. Tom and Sarah are using the exact same tools. They both see pips, they both choose a lot size, and they both use leverage. But Tom uses them to gamble. He's taking hopeful shots, probably with way too much leverage. Sarah, on the other hand, uses them like a surgeon uses a scalpel, as precise instruments to calculate and manage her risk, which allows her proven edge to work for her in the long run.
So that really leaves us with one final and really important question. When you look at what you're doing in the markets, are you a Tom or are you a Sarah? Are you building your decisions on proven math and discipline, or are you just kind of crossing your fingers and paying the market tuition in the form of expensive hope? The choice, ultimately, is yours.